Hello everyone and welcome back. In today's lecture, we are going to analyze how a perfectly competitive firm makes a decision in the short run. In the previous lecture, we learned that the firms in perfect competition are price takers. Today, we will build on that idea and answer the most important question for the firm. How much should the firm produce in order to maximize profit? So let's begin by connecting the firm's decision to basic economic equations. In a perfectly competitive market, the firm must accept the market price determined by the supply and demand. The firm cannot choose the price, so its only decision is the quantity of output. We define total revenue as total revenue equals price multiplied by quantity. This means that for every unit the firm sells, it earns the same price. The total cost is defined as total cost equals average cost multiplied by quantity. This reflects the total expenses of producing that level of output. Profit is defined as the profit equals total revenue minus total cost. This is the key objective of the firm. The firm wants to choose the level of output that maximizes this difference. Now let's visualize this relationship. Total revenue is a straight line that slopes upward because price is constant. Every additional unit sold adds the same amount to revenue. Total cost also increases with output, but its shape is curved. At higher levels of output, total cost increases more rapidly due to diminishing margin return. Profit is the vertical distance between total revenue and total cost. When total revenue is above the total cost, the firm earns profit. When total cost is above total revenue, the firm experiences a loss. Now let's identify the profit maximizing point. At low levels of output, less than Q1, total cost is higher than total revenue, so the firm is making losses. As output increases, total revenue eventually exceeds total cost, and the firm begins to earn profit. However, beyond a certain level, Q2, costs rise faster than the revenue and profits start to decline again. The firm makes profit only between Q1 and Q2, green area. The maximum profit occurs at Q0, where the gap between total revenue and total cost is the largest. This is the firm's optimal level of output. Now let's take a look at the table. Profit is calculated as total revenue minus total cost. At low levels of output, profit is negative, indicating losses. As output increases, profit becomes positive and continues to grow. At quantities of 70 and 80, profit reaches its maximum value of $90. After that, profit decreases as costs increase more rapidly. This confirms that the firm should produce around 70 or 80 units to maximize profit. Now let's introduce a more practical approach. In reality, firms do not usually calculate total profit at every possible levels of output. Instead, they focus on small changes. There are two important concepts to find the profit maximizing quantity. Marginal revenue is the additional revenue gained from selling one more unit. Marginal cost is the additional cost of producing one more unit. Mathematically, marginal revenue is the change in total revenue divided by the change in quantity, and marginal cost is the change in total cost divided by the change in quantity. Now let's talk about the important rule to find the profit maximizing quantity. A firm maximizes profit at the level of output where marginal revenue equals marginal cost. In perfect competition, marginal revenue is equal to market price. So the rule becomes marginal revenue MR equals price equals marginal cost MC. This means the firm should produce the quantity where the cost of producing one more unit is exactly equal to the revenue gained from selling it. Let's apply this idea. The market price of raspberry is $4. Since the firm is a price taker, uh, it must accept this price. This means marginal revenue is equal to $4 for every unit sold. The firm decision to find the quantity where marginal cost equals 4. Now let's calculate marginal cost. As you know, marginal cost is calculated as the change in total cost divided by the change in quantity. You can see the marginal cost at every quantity sold. At low levels of output, marginal cost decreases due to increasing marginal returns. After a certain point, the marginal cost increases because of diminishing marginal returns. This explains why the marginal cost curve is eventually upward sloping. Now we compare marginal cost with marginal revenue. Since marginal revenue is constant at 4, we look for the quantity where marginal cost equals 4. From the table, we see that this occurs at 80 units. Now we confirm this using profit values. At 80 units, profit is $90, which is the maximum. This confirms that the marginal revenue equals marginal cost rule gives us the profit maximizing output. Now let's interpret the right graph. The marginal revenue curve is a horizontal line at the market price, $4. The marginal cost curve slopes downward at first and then upward. Based on the MR equals MC rules, the intersection of MR and MC determines the optimal profit maximizing quantity, which is 80 units. So now we ask an important question. Does producing where marginal revenue equals marginal cost guarantee profit? The answer depends on the relationship between price and average cost. Profit margin is defined as price minus average cost. If price is greater than average cost, the firm earns profit. If price equals average cost, the firm breaks even. The price is less than average cost, the firm experiences losses. Now let's carefully analyze the case where the firm is making a profit. In this situation, the market price is $5. As we discussed earlier, the firm still follows the same rule and produces the quantity where marginal revenue equals marginal cost. Another rule, optimal quantity is 85 units. At that output level, we compare the market price with the average total cost. The key concept here is profit margin, which is defined as profit margin equals price minus average cost. So at the quantity of 85, we take the market price of $5 and subtract the average total cost at that output level. Suppose the average cost is $3.5. This gives us a profit margin of 5 minus 3.5, which equals $1.5 per unit. This means the firm earns $1.5 of profit on each unit it produces. To calculate total profit, we multiply the profit margin by the number of the units produced. So if the firm produced $85, total profit is $127.5. Graphically, this profit is represented by a blue rectangle. The height of the rectangle is the profit margin, which is the distance between price and average cost. And the width is the quantity produced. Now let's consider the break-even case. In this situation, the market price is $3. The quantity where ML equal MC is 70 units. And at the profit maximizing quantity, average total cost is also $3. Again, we calculate the profit margin. Here it is the 3 minus 3, which is equals 0. So this means the firm earns 0 profit per unit. To calculate total profit, we multiply the profit margin by quantity. So total profit is 0. Even though the firm is not earning profit, it is also not making a loss. It is covering all of the costs, including both explicit and implicit costs. This situation is still considered acceptable because the firm is covering its opportunity costs. Now let's analyze the case where the firm is making a loss. In this situation, the market price is $2, while the average total cost at the profit maximizing quantity is higher, let's say $2.73. We calculate the profit margin again. So here it is, 2 minus 2.73, which equals negative $0.73. This means the firm is losing $0.73 on each unit it produces. To calculate total loss, we multiply this negative profit margin by the quantity. So if the firm produces 65 units, total loss is negative $47.45. This means the firm is experiencing a total loss of $47.45. Now let's introduce the shutdown decision. In the short run, firms must decide whether to continue operating or shut down. The key concept here is average variable cost. The shutdown point occurs where the marginal cost curve intersects the average variable cost curve. If price is less than minimum average variable cost, the firm shuts down. Uh, if the price is greater than average variable cost, the firm continues operating, even if it is making losses. Now let's carefully look at this situation. In this case, firms is still producing at the level where marginal revenue equals marginal cost, which is the profit maximizing output. However, when we compare the market price with the average total cost, we find that price is lower than average total cost. This means the firm is making a loss. At this point, it may seem reasonable to think that the firm should shut down. However, the key idea here is that the firm does not compare price with average total cost when deciding whether to shut down. Instead, it compares price with average variable cost. In this graph, we can see that the market price is still above the average variable cost curve. This means that for each unit the firm produces, it is able to cover all of its variable costs, such as wages and raw materials. Even though the firm cannot cover its total cost, it is still covering part of its fixed cost. If the firm shuts down, it would lose all of its fixed costs. By continuing to operate, the firm reduces its loss because it earns enough revenue to pay for variable costs and continue something toward fixed costs. So in this situation, the firm should continue operating the short run, even though it is making a loss. Now let's look at the situation where the firm should shut down. Again, the firm is producing at a level where marginal revenue equals marginal cost. However, now the market price is even lower than before. When we compare the price with average total cost, the firm is clearly making a loss. The profit margin is negative and total profit is also negative. But the critical difference here is that the price is now below the average variable cost curve. This means that the revenue the firm earns from selling its output is not even enough to cover its variable cost. In other words, for each unit produced, the firm is losing money not only on fixed cost, but also on variable cost. If the firm continues to operate, it will increase its losses because it cannot even pay for the inputs required to produce output. In this situation, the best decision is to shut down production in the short run. By shutting down, the firm stops producing and avoids paying variable costs. The firm will still incur fixed costs, but those costs cannot be avoided anyway. So key takeaway here is that the shutdown decision depends on whether price is above or below average variable cost. If the price is above average variable cost, the firm continues operating. If price below average variable cost, the firm shuts down. Thank you for watching.